And we are live. Welcome, everybody. It's masterclass time. It's webinar time. Very excited about this topic. It's the last webinar of the year. We're going to talk FX hedging. We're going to talk about the US dollar dominance or not. We're talking about de-dollarizations and how treasurers can build the right hedging strategy. I have two amazing speakers here. I have Camille from Ebury. He's FX structurer, FX dealer. He knows everything about FX hedging strategies. Setting the scene here for you, Camille, your expectations. And he talks to a lot of clients about hedging strategies. Then we have Nacy, CFO advisors at Angola Airlines. She's the treasurer voice here, the practitioner and the user, and a lot of experience with dollar hedging. Dollar proxy hedging as a not functional currency, and she will have the treasury experience here. We do have a lot of options to ask questions. Use the chat to ask questions to us. Don't wait till the end. We have 5 to 10 minutes at the end for questions reserved, but definitely ask them on the go. Use the chat now. Tell me where you're from. Tell me why you're joining this webinar. I'm always curious to read it. While moderating this webinar, I will definitely read those. If there's a question relevant at that time, I will ask it in between. But let's lose not too much time and dive straight into it. I also want to engage the audience a bit and want to ask you first, the audience. You've joined this webinar for a reason. So let me ask you, let's start with a poll question. What's your company's biggest US dollar related challenge right now? Is it the FX volatility? The dollar going all over the place, number one. Is it number two, slow and costly US dollar cross-border payments? Or is it number three, the hedging strategy? I have no idea how to hedge. Should I go long term? Should I do rollovers, etc.? Please put it in the chat. 1, FX volatility. 2, slow and costly US dollar cross-border payments. Or 3, hedging strategy. Curious to see what you come up with. I already see the first one, FX volatility. Another 3. Is that what you would expect, Camille? The volatility is set on the client's agenda?
Yes, volatility was my expectation. That was the predominant answer here.
Okay. Is that also what you're seeing, Nacy, in your companies? Is for FX volatility really high on the agenda? Is it hurting? Is it making you have sleepless nights?
Yeah, definitely FX volatility is the most is top on priority because it's a cost for us at the end of the day. So we're consistently checking and evaluating our volatility.
Mm-hmm. Yeah. Okay. Makes sense. Then let's dive into de-dollarization. It's a really catchy title, but it's also what we see happening. So Camille, let's start with you. So de-dollarization, most people think the US dollar suddenly is going to collapse. It's not going to be the dominant currency anymore. That's not necessarily what's happening. How would you describe the real shift taking place currently?
No, it's more gradual. I remember, I think it was back when I was a student, there was this is more for Dutch people, Tegenlicht documentary, and it was called The Day the Dollar Falls, and then that would create a lot of havoc in financial markets and panic and anxiety. This is not something that is ever going to happen. I mean, if anything, the dollar won't fall out of the sudden. It won't be a sudden move that impacts everyone to start using a different currency. But we do see a gradual shift moving away from the dependency of the dollar. There's a very famous quote, of course, that everybody knows. It's our currency, but it's your problem. And especially, of course, for emerging market debt is a good example. It was predominantly denominated in dollar. When there is a crisis, it it's extra hurtful for those type of countries. When the dollar strengthens. It has always been the case, of course, that the dollar is the predominant currency that is used in international trade flows. But especially China is now really making an effort to steer away from this. And there are not many candidates to replace the dollar, to make a different reserve currency. The only two likely ones is the Chinese renminbi and the euro. But we do see some initiatives in the market now that also politically driven. That there's an effort of moving away from the dollar more.
Yeah, the Trump effect.
Yes, the Trump effect. This slide is visible now for me, for the audience as well, Patrick, or
yes.
just for me?
No, for the audience.
Yeah. So this is one thing that is very different if you compare Trump's second period in office to the first one, or let alone Trump, just policy, economic policy that's very different from the years compared to in the past. The US was always there as a more of a safe haven to make markets more calm when there's unrest than when there's turmoil. And what we actually saw during the self-proclaimed Liberation Day was that a correlation that has been more of a rule of thumb for decades, that whenever there was volatility in the world, the dollar would strengthen. It was a safe haven currency. Your assets are safe there. Every asset manager would fly into dollar safety. And you see in this chart, indeed, that this correlation broke, and it hasn't. Even though the markets have come so what we've seen, of course, equity markets being quite resilient, rates also very stable. But this correlation, even if there's only small sparks of volatility, what tends to happen now is that the dollar actually then weakens instead of it strengthening. And the euro dollar move that we saw in this year from 102 to 120 almost, this was driven by a lot of asset managers that actually decided to hedge their exposure to the US that in the past they never did, because the reason of their thinking always was, and it was backed up by the results, if my investments in the US go poorly, then typically the dollar would strengthen and I will be hedged by not hedging, essentially. And since this correlation broke, they started to hedge those exposures. And that is a really strong driver for the dollar weakening this year.
Yeah, interesting. Lacey, what are you seeing from a practitioner perspective? You're a treasurer, CFO advisor, you see a lot of cash flows, you are in difficult markets where the dollar is fairly dominant. Do you see a shift in payment behavior, invoice currency, even settlement preferences?
Definitely. I've been treasury for almost 10 years directly, and I see all kinds of evaluation situation. The highlight point for me is the adjustment. I can see an adjustment between companies. They becoming partners, because as an example here in Angola, a local company can only issue in kwanzas, but sometimes they have to import things, have to make payments overboard, and they depend on the central bank for US dollars. So we need to have all kinds of strategy to be able to pay. So a big strategy currently is to not buy without sell. So you can reduce liquidity, the amount that you're going to transact. And also have overboard positions. It's the main thing you have to do as a company, because if you want to pay without if you have an immediate need to pay overboard, you cannot wait for bank authorization. It's a very long process to collect authorization from central bank, because they are the one who can allow you to pay. So you have to be tricky and be have to be wise to know what to do, when to do, and how to pay. So we are using a lot of technology at this moment, a lot of cloud banks, renegotiating contracts. I can see an evolution on the way we pay. I can see quality. I can see more and more expertise from the people who's doing payment, and I can see the other markets understanding this difficulty that we have at this moment as a country, liquidity problems, and they're trying to adjust because they want to do business in our country. So I can see certainly a lot of evolution from the days before. Okay, like in 5 to 8 years, we usually take more than like 45 days to make payments, and now we're doing 24 hours. So it's a big evolution from there to now.
Yeah. So cash is still king.
Still,
But if the alternative of the local currency is difficult, then the alternative is probably still US dollar. But for
yeah.
that, you depend on the liquidity of the central bank, and their policy in that. And there's not necessarily an alternative there.
We are taking alternative. A big alternative we are taking at this moment is the euro currency. Okay, because we usually transact in dollars, but we are taking euros as an alternative when we don't have dollars available. So you
Okay.
can like use dollar euros. You can use rands, South African currency, and to make payments of abroad. So we have this channel open. So instead of just be stuck with dollars, we are using euro as well.
Okay, that's very interesting. Camille, is that something you are seeing as well? Why is this shift happening? Is it then we don't trust Trump, or we don't see it as a safe haven? Geopolitics? Is it commercial logic? Just it makes sense to look at euros, or just simple cost efficiencies because euro forward premiums are pretty low as well. What are you seeing?
Well, we see it as well, and especially from my line of work, where our bread and butter is in the conversion itself. We don't love it when clients suddenly decide to pay in euros. So we always are very careful. Okay, we understand that this is happening, and what is the reason behind this? But indeed, it is. I think the bigger play here is like if there are three factors indeed that can drive the de-dollarization, um, geopolitics, commercial logic, or cost efficiency. I think geopolitics is the driver. So that sets the stage and that influences the other two as well. In the past, when a supplier from China was used by a European importer, I remember that they were only eligible for a tax rebate if they were invoicing in US dollars. So the system was set up towards the dollarization. It was it's very strange to me. And what we see now, it's actually the opposite, that whenever they're not invoicing in renminbis, there are some sort of documents, and what it exactly is escapes me, but I can always follow up. That they have to explain to the government, no, okay, we're invoicing in not in renminbi but in dollars. But yeah, that whole tax effect now is actually the opposite. So they're only getting it if they're actually getting paid in renminbi, and that tells you that yeah, there is some undercurrent here in a shift away.
Oh, that's very interesting. So still this geopolitics. So the politicians, indirectly the central banks deciding on how we should pay and what should be the dominant currency to pay out. And then the euro might be too small compared to the dollar, maybe even compared to the renminbi. Saw a presentation last week. Of course, China has a big trade deficit, but at the other side, renminbi used as a global currency, I think it was only 2%. So I was quite surprised by that low number, even though the internal China market, it's obviously huge, and the currency itself is huge, but in the international payments, it is definitely not. So the dollar is still there. But then, Nancy, let's go to you. still feels weird to me to use the dollar if you're not in the US. Of course, if the local currency is not strong enough, that's the alternative to go. But I think companies then underestimate the exposure which is in the supply chains then, because I use dollars to buy, I use dollars to sell. That's a natural hedge. But isn't this a blind spot then? Because that's still an exposure.
Yeah.
What are you seeing?
I'm seeing, I've been seeing a lot of stuff recently. There's a lot of influence from governments, from geopolitics decisions, but also for me, there's a commercial logic associated to things. Example for Angola, we import a lot from China. China is a big sponsor here, like more than 50%. But as well, we are looking for other markets such as Brazil and Europe. We consume a lot from Europe as well. And so it's a bit of both. Okay, there's a logic for geopolitics situation. You also, let's say, a cost efficiency / commercial logic associated. We were stuck. Okay, we were forced to move from dollars and take an alternative because we were stuck for years. We only transact in dollars, and at certain point we got stuck because they shut down all the resources. There were no dollars coming to the country. Our economy, it's going around the oil and gas sector, and once the crude amount went down, we suffered a lot. So from one day to other, the dollars went off. Okay, so we need to find an alternative because we still need to import a lot because we don't produce enough for our economy. So we still need to pay. We still need to import and we have to pay. So we had to open other markets, other lines, and to be able to maintain our economy. And so for me, it's a bit of everywhere. Okay, there's a lot of influence. We still have a central bank that controls. They shouldn't be controlling anymore. They're more in a ruler perspective and everything. I know this is the way they are trying to achieve, but still the market's not mature enough to deal on his own, to transact on its own. We need to take step by step, firm steps. We need to be able to have a lot of instrument control rules and everything to be able to transact freely. Okay, at this moment we are living in a huge inflation process, and we need to step down a little bit. Okay, we need to be able to control the market a little bit more without the influence of the central bank.
That is a difficult prediction to make. You have to predict
Yes.
how's the economy doing, how's inflation, interest rates, and central bank liquidity. All
Yeah.
that combination, that's almost impossible. But that's what we're dealing with as a treasurer, predicting the future and then adjusting our exposures and hedging strategies. We will go into that in later questions. Camille, I want to ask you, if we have such a company which is dollar-centric, dollar-dollar, you still have exposure. How do you help your clients determining this multi-currency exposure? What's the right starting point, really?
This is very basic in a way. I mean, what we always ask clients to do is, okay, have a clear picture of where are your payments going to, and where are your payments coming from, and are there different currencies involved, or is it just dollar? Have local invoices ever been explored by either your purchase manager or your sales? Sometimes we see some surprises there that indeed it's always been dollar just because it has always been dollar, not with too much thought behind it. And indeed, I brought this slide today to evidence what you can risk if you're hedging the wrong currency. So what you're seeing here is a chart of dollar renminbi. As I said before, the renminbi is then, if we're talking about de-dollarization, this is the most likely candidate to take over some portion of the dollar payments. And what we typically have seen here, that whenever the dollar weakens, your supplier, imagine that this is indeed a buyer-supplier relationship, that suppliers from China, which is typically the case, then hikes the price. This happened in the past a lot. You will be confronted with this, I'm sure. And that means you set a different budget rate. But then if the rate moves the opposite, it's rarely that a Chinese company will come to you and say, hey, you get a discount now. Of course, they will just pocket that additional FX benefit. So this is an example of course, hidden cost if you're hedging here in dollar, but you're actually paying in renminbi. And this can differ from case to case. So sometimes there actually is real merit in a client wanting to receive dollars, because some Chinese suppliers, they have their own cost in dollars because they buy raw materials that are denominated in dollars. So if that is the case, then you can agree, okay, this is fine, but then make very sure this is the price and we're only changing this because of reason A, B, and C, not because of FX moves. But typically we see that the Chinese, they tend to use the FX volatility in their favor and just add to margin.
Yeah. So you always have to think about, is this hedging my FX exposure, but what about the FX exposure of the receiver? Because in a dollar, if your dollar is not the functional currency of the receiver, then it's also an FX exposure to them, like you rightfully say. Of course, if they have a natural hedge, it doesn't. But this is a great example. Prices are hiked 5%, and the currency moves back into your favor, but it's never going back to 100 somehow. It remains at the 5. And in this case, you would have been better off paying in renminbi. Of course, you would have had a bit more volatility, but you can hedge renminbi as well, right? We'll go into that later. Are you seeing clients doing this more, moving to local currency hedging?
Yeah, I am seeing this, and also we also now see indeed the move to euro. Again, then this is one of the charts that we tend to at least make visual. Okay, if you do this, the first thought might be, oh, that is easy and that's very simplistic, but that would actually mean, if that were to work, but you're paying indeed to a supplier or getting your money from a client in a totally different reporting currency, that this will only work if FX stays the same, because then everybody's happy. And typically, we've seen, of course, from the last year, with the euro dollar moving 15%, there will always be a party unhappy. So there will always be a point of renegotiation. And then the question is, do you want to be the one that is driving this negotiation, or to be the one that just has to accept it? So sometimes there is merit to actually taking on this FX risk, because then you are the one who can be the controlling party when starting renegotiations of the contract.
Yeah. And that's also what you're doing in AC. You mentioned you moved to euros, looking at alternatives to the dollar, right, AC?
Yeah. We are moving, but gradually we have some openness in dollars recently. I don't know what's happened. Like I said, we don't control the liquidity of the currency. But for me, the big strategy here is to have one-to-one with your partner. Okay, I've seen the suppliers and us as a company trying to adjust and to adapt and trying to reduce for both sides the risk and the hedging, trying to help each other to navigate to the situation that we cannot control. They still want to do business, we still want to do business, and we need to adjust and adapt and try to find blind spots where we can adjust. Sometimes we pay suppliers in the region that they don't have a formal operation, but in their position they have a better use for the money, and we can pay directly in reducing our costs. So we constantly have to find strategy situation to situation. We cannot establish a rule for everybody. We need to look into each suppliers and trying to find the best strategy for this particular suppliers, and considering our limitations here in Angola. And if you have a positions overboard, in the other company that I was, we have a certain positions and we could move payment and reducing our costs. In this company that has a huge position because it's an airline company, we have a different capacity, so we have more options to negotiate with our supplier. But still, the base, the head office is in Angola, which means our massive collection is in Angola and it's in Kwanzas. So if you want to pay the bigger bills, it's from Luanda. It's never from other places because the huge collection is here. So we still need to convert Kwanzas to US dollars or to euros and pay. So you need a lot of support from central bank. They need to know the criticality of payments. The commercial bank, they need to be a partner, a true partner with us and help us to find a good strategy where they can pay, where they have an ability. If you can to pay in dollars or in euros or other currency, they might help our suppliers collect even faster and without any kind of disadvantage. And for us, the same place.
Yeah, that's very interesting. So even if you're the smartest, have the best exposures, and have the nicest credit lines, you're still dependent on your suppliers, on the liquidity, the central bank, etc. But of course, you can influence it. And Camille, hedging strategies was one of the answers in the poll. Let's talk use cases. Let's talk hedging strategies. So in this difficult FX market, even the euro dollar is not stable anymore. What are the hedging strategies that I'm not saying which are going to work, but which are you seeing the most? Which makes sense today in today's market?
We've seen clients been really asking to adopt or to explore different strategies that move away from, let's say, static or rolling hedging, or moving more to layered hedging, just to dampen the effect of sudden spot moves. What we also see is clients that have a bigger appetite for products that have an option element to it. So I think there was a long period, and this was driven by, let's say, the interest rate scandal, which, well, there's definitely a big factor in the Netherlands. Maybe it was in a broader of Europe. I'm not sure, but Patrick, maybe you know. But yeah, the interest rate derivatives, where clients had to post margin call, that really had made sure that there was a negative connotation with options. But yeah, we see it as an instrument that can actually dampen volatility when used correctly, and it can allow clients to have a worst case rates which they can budget with. But if there are sufficient strategy in place, of course, they can actually benefit from spot moves that can arise, of course, during normal trading behavior of their underlying currency. And this is something they really like, because if, of course, you're hedged and you see a very big volatility move, as we saw in this year for euro dollar, you're either wrong or right if you have used static hedging in the past. But if you have the ability to benefit from certain spot variations while having hedged for the worst case, then you can actually benefit from this volatility.
Yeah, that's interesting. And I'm a treasury consultant myself. Always, if you do big hedges, the rate moves in the opposite direction. And the CFO says, "Great timing, Patrick. If we wouldn't have hedged, we would have made so much money." And I was like, hedging is an insurance. It's an insurance premium. If it would move in the other direction and we saved so much money, or lost the money, the CFO would never have said anything. So I like this option character, but I also see clients struggling. Okay, it's more difficult. I don't fully understand options. We've always done it this way, but you simple forwards and a rolling strategy. So you're clearly saying revisit your exposures, your hedging strategy, because the world changed. Maybe your hedging strategy needs to change as well.
Well, we always in the past this product offer was always on the table, but we saw clients did not have a great appetite for it. And this year we see clients really asking proactively themselves about it. From is there another product that you can offer me where actually I am hedged, but I can benefit still if volatility comes in and it's actually in my favor. And then, of course, the only option is an option product, and there's a lot of names for it: forward extra and leverage forward, or whatever, range forward. Bear in mind, this is always just a combination of options, and but they use the word forward because it's protection, of course, for future moves. But it can be a great instrument if used correctly.
No. Yes. Is that also what you're seeing, Nacy? But then how do you balance simplicity? It's an easy strategy to do rolling forwards versus complexity. Try to explain to your CFO how an option works, and definitely to your accounting how they need to put that in the GL accounts.
Yeah. Being completely honest, hedging is not a very practitioner here. We don't do that much because we are not able to even stock hard currency. So hedging is a thing that's very hard for us. Also, there's a lack of literacy in that particular subject. Okay, we need to understand we don't have rules, we don't have options here to hedge. To hedge, we don't have. Okay, let's be completely honest here. We know as a theory, we know that there is options. There some strategy we can use to prevent and to reduce the instability of our cash, of our treasury, but there's not such a thing as hedging. We don't use these practices because when we don't know, we don't do. Let's be clear. When we don't know, we don't do. So here it's still a long way to pursue. I think we need start a little bit more and have a stable currency. Local currency needs to be more stable so we can predict a little bit better. Okay, if we can predict a little bit better, maybe we can start doing those protection actions to prevent us from losing. Okay, most of the operation they are losing a lot of money every day because we don't use any kind of protection. We cannot predict. Let me give you an example. Around 5 years ago, $1 used to the dollar was issued for 400 kwanzas. From one day to 2 to 5 days, the inflation went for almost double. So you lost almost 100% of your value. It's very difficult for you to predict because we didn't know this would come. We couldn't see signs on the market because the public reports, they couldn't help us understand and predict this and trying to adjust or prevent or protect our currency. So it's very hard for us. The thing that I usually do is keep it simple. Keep all the information simple as possible. Trying to simple and clear, have a clear vision what's going on in the market. Trying to have some predictions. Sometimes we nail it, we are able to reach this prediction, and most of the time not. But try to see the market behavior and try to adjust the whole operation and the way we do things, and try to anticipate costs to not be able to reach at the top of the cost, and sometimes be able not to pay. So it's a hard sea.
It would be very cool if it's easier predicting the future for treasurers. Then we wouldn't be treasurers; we would be doing other stuff. But is that a thing, Camille? Because I hear Nacy saying costs. I hear some of my clients say, "Ooh, hedging has become expensive. Interest rate differentials have grown." let's not move a hedge on a yearly basis, but on a 3 months basis, because that's cheaper. Is it really? How are costs important to treasurers? The cost of hedging, and where are we overpaying? Where are we underpaying? Or should we just don't care about it?
No, you should absolutely care about it. And I always like strategies where the treasurers evidence to me that they're aware of it and they're thinking how to play around with it. That interest rate differential that you mentioned, for instance, and again, I'm using the euro dollar as an example. The forward points, the differential between the euro and dollar, they actually have come down. So if you now compare the cost of hedging for, let's say, a year, compared to today and Liberation Day, it is almost 1% lower than it was before. So it would now actually be more wise to hedge longer tenors, or at least the cost of hedging has gone down, if you're on a rolling hedging strategy, unless of course you have a bias that the interest rate differential is going to decrease even more. But that's just one factor. What you can also think of, if you are exposed to multiple currencies, for instance, you're selling to the US, but you're buying raw material from, let's say, Brazil, then it would make sense to maybe hedge a lower amount of your exposure to the US because there's a negative cost attached to it, but actually to hedge a higher amount for your imports because there the forward points are in your favor. And those type of strategies are some that I like, and I always try to map out, especially if they're multiple currency exposed to the client. And talking about cost, I mean, what sometimes clients are not aware of is that the forward facility that they have with the bank, that actually draws capital if positions are out of the market, and they pay an interest for that. Sometimes clients are not aware of that, but they have become aware for instance, dollar buyers that are now exposed to out of the money contracts, given that 15% move that I previously discussed, and then they see their fee for their debit interest increasing, and then this is an element of it. But sometimes, they're not aware that it actually is part of their credit facility.
Yeah. The everlasting struggle between credit lines, FX lines, but also the predictability. And fully agree. I've seen opportunities where the forward points are really in the favor, and we should be hedging longer. And Treasury sees that. But then it's, can the business deliver? Because do I even know my exposure 1 year from now? I have a guess, but that might be 50% certain only. And I also don't want to overhedge. And then I see clients saying, you know what, I don't know my exposure, or it's too uncertain, I am not hedging. I always like the phrase or answer then, not hedging is also a hedging decision. They don't always like to hear. But the question then is, can you afford to not hedge? Or can you make that business decision not to hedge really in combination with poor execution? Nancy, that's probably something you are stuck with, right? Because you're saying, I can't always hedge. I have to accept the market how it is, right?
Yeah, sorry, got cut a little bit. I have to accept the market how it is and have to deal with it, the reality. So day to day, we face sometimes a new reality each week, and we have to adjust and adapt to the current reality. Like I said, keep it simple, keep the strategy right to the focus on the business, okay, and how to deal with the adversity and the uncertainty that we deal in every day, because it's not very easy. It's not easy at all. Sometimes your position go like 300 and 180% around of what you thought that what's going to be, and it's not a very easy. It's not easy. Easy for me isn't easy. It's the word for me. It's easy. Isn't easy to know what's going on, how the market's going to behave next week, because we cannot. Even when we study the history of the market behavior, still something can happen in the other day that can change the whole market.
Yeah, no, definitely. And we're entering the last 5 minutes of the webinar. So to the audience who's listening, now is the time to ask the questions to Nancy, to Camille, to me, if you even want to pick those brains and ask your questions. I want to move to you, Camille. I want to come back to this hedging strategy. Let's say we inspired some people and they say, okay, I'm not going to do dollars anymore to China. Let's renegotiate. I'm going to hedge. I'm going to pay in renminbis, so I want to hedge renminbis. The initial feeling and thought might be, ooh, that's a lot more volatile currency. It might be more expensive because the forward points are higher. The interest rate is higher, so higher forward points. So it could be more expensive. But hearing at your argument, it says, yes, but it's more stable for the receiver. So you have less price volatility in that end. Can you share some examples of clients where this happened, where they moved away from the dollar and actually reduced costs? It increased predictability?
The argument of liquidity, of course, it depends on the volumes that you transact, right? But yeah, in my sector, sometimes that is an argument indeed, and brokers say no, renminbi, so we have to increase the price. This is bollocks. I mean, this is such a liquid currency nowadays. It's the same as dollar. It's the same as euro. So the liquidity will not be much lower for renminbi compared to dollar or euro. So this should not affect price. And yeah, there's always a cost involved with hedging, and indeed there's volatility that you then hopefully avoid, or at least it becomes more predictable. But what you can actually use it for when you renegotiate payment terms, it's sometimes that if you give the client the option or the supplier the option, asking them to invoice in renminbi and compare that to a dollar invoice, you might see that you're actually cheaper off in paying in renminbi or in dollars. And if that's not the case, then sometimes you can ask, okay, if well, there will always be a discrepancy between those rates, and then you can ask, okay, but if you want to do, since this rate is cheaper for me, are you willing to negotiate, or can we lower the price? So I tend to use it as a also price, renegotiation mechanism.
Yeah, no, makes total sense. And some of them are open to it, and some might be not.
Yeah.
But you're really saying because they already price in dollars, they put a premium, a volatility in the price already, to not having to adjust the price all the time if the dollar rate changes. So you might get a discount. Good point. And then you get a discount, but you get maybe more volatility, but the liquidity is there. So it might make sense. And yes, it takes effort to change the way you do it. So you have to put some effort in it. You have to do some change management. I think that there's a comment there. In case of renminbi, I believe price formula with considering the currency ranges as the euro dollar can be an option. Not fully sure what's meant here. I think that's what I just mentioned, that there's a margin in between there. Looking at the last 2 minutes, Nishi, looking ahead, we might have inspired some treasurers to revisit their hedging strategy, to move away from the dollar, to at least have a look at their invoicing, currency strategy, payment terms, etc. What's the one advice you would give treasurers for 2026 and beyond, looking at the FX side, of course?
For us, like I said, I like to take this advice not for others, but for myself. I'm trying to study a little bit more about strategy, hedging strategy here in Angola, and how what solutions are coming into the market that can help us transact a little bit better and protect our position and our capital. There's not a lot of instruments available, but I'm looking inside and outside and how we can incorporate other solution based on technology, based on future options and everything, how we can obtain those solutions and to implement here to try to give us a better position to negotiate terms, negotiate payments, to transact and reducing our local costs, because currently we have a tremendous amount for any kind of transaction. So my let's say advice is preparation, study, and trying to look into option and trying to bring them into the region, for discussion with partners.
Yes, that's great advice. Camille, what would be your advice? And don't say now do more FX trading, because that would be in your interest. No, what are your thoughts?
Have a strategy in place and stick to it. So, and also the second part is important there. So sometimes clients have a strategy there. They have committed to a layered hedging strategy where the longer you hedge into the future, the lower percentage you hedge. But when the times, of course, nears in you, then you start to hedge again. So this is just to dampen the effect of the spot rate. So you won't beat the market with it. But that what we tend to see there, that if the first rate has gone right, they stop hedging because they think, oh, the rate can move any further, or it has gone wrong. They stop for the same reason, because they say, well, we were better off not hedging at all. But then, of course, time progresses, and then they thought, oh, well, the strategy was actually working. So sticking to the strategy, that is, I think, something that is overlooked quite often.
Yep.
And also seeing Mr. Egan's question, let me comment on that as well, because I saw it in the chat.
Mm-hmm.
When you are expecting incoming payments, but of course you never know exactly when the payment is coming in, so you need some flexibility. Just make sure that the provider you are working with provides you this flexibility by being transparent about the swap that you can always use to book to make the tenor right. So in this case, for instance, if you hedge this for 2 weeks too short, you paid less forward premium, so there will be a cost attached to making the hedge a little bit longer, but those costs are typically very small. You could have then provided yourself more flexibility than booking a longer hedge, but then you would have paid for those forward points. So my advice always is stay somewhere in the middle, but be sure to have educate yourself beforehand. So if there is a payment coming in earlier or later, what are the costs involved with that? And there is all the providers in this space are able to provide flexibility. You should just make sure that you're not paying a premium for that flexibility offered to you.
Mm-hmm. Those are nice parting words. I hear Nisi saying, educate yourself, what is out there. I hear you saying, Camille, choose your strategy that works for you. Test it out. Don't keep changing all the time. Yeah, you're not chasing profits here. Your goal is to really hedge. And of course, look at products that work for you. But also the flexibility. I think that's a key part, because your strategy might work for you. But if you're a small treasury team with 1 or 2 people, but you're swapping every day for a couple of hours, that's also not a workable solution. But that comes back to Nasi saying, educate yourself. There are more flexible products out there which could be working better for you. And I hear you saying, Camille, don't focus only on the price. It might be better off paying a bit more forward points, but having then the flexibility to adjust everything.
Exactly.
Amazing parting words, and it was worth the extra 5 minutes on this webinar. Nasi, thanks a lot for your inputs. Camille, it was really great having you from a trader perspective and what you are seeing in the market. Thanks, Ebury, as well, for providing some of the slides. Thanks, audience, for being here, for asking the questions, and for participating in this webinar. After this webinar, everything will be put on Spotify and YouTube. You will also receive from Ebury the FX Dollar Playbook, which is a really interesting guide on how you can deal with the changing de-dollarization and hedging strategies in there. We will put the link in the thank you email that's coming to all of you. So thanks all, thanks audience, thanks Nancy, thanks Camille for being in this webinar. Thank you and have a nice day.
Thanks everyone. Thanks for the opportunity.
Thank you guys.